Today's video is all about a simple way in which to set up your accounts, your bank accounts, and keep track of the flow of money through it when you earn your money through a company. So you could be a contractor, you could have a business that's set up through a company, whatever it is. This video is all about keeping that whole process really simple. I've been getting so many questions around how do I make sense of this? Because I've got tax, I've got my spending, I've got company, I've got personal situation. It's all getting really confusing. How do I take all of that, make it clear, and keep track of all of those figures so that I'm making sure I've got enough money for my taxes, enough money for the things that I want to be doing day to day, and all those other unforeseen situations. So guys, if that's of interest to you, stay tuned. Hi, my name is James Corsia and welcome to the Money Paradox podcast. Yes, we're going through this super useful video. It might get a little bit technical with numbers and so on, but guys, bear with me. This is so important. Many people, they're chasing making more money and so on. But if you get this dialed down, this is a complete game changer. Those that I've worked with that are able to drastically change their situation, this is really at the core of it. The people who I see that are successful in my life and around me adopt this. And when they make the shift, their financial situation is 10 times better. Yes, earning more money is important, but if you're not handling the money that's coming in the right way, you can get really stuck, really confused, overwhelmed, and that can bleed into everything else in your situation. And guys, that happened to me. You know, my situation was getting more and more complicated because I was having income from different sources and so on, having to save up money for different areas, money flowing all over the place. I had loads of different accounts and it was getting really confusing. So I did this for myself to try and get it simple, and I kept kind of coming up with different ways for those that I was working with and friends and family around me, right? And so guys, what I'm going through today is really the simplest way in which I can kind of tell you this. But before I go into that, I want to kind of explain why this is so important. So firstly, look, you know, I earn money through companies, a number of different companies, right? And money through my personal situation. And that gets really complicated. And so it's very hard to keep track of where money should go and where money shouldn't, right? So by doing this, it allows me to know where money should be, how much I need to keep in store for it. So for example, money going into my company. Well, I've got costs for my company, right? How much are they? Have I got enough in there to cover that? The tax for my company, corporation tax, VAT. Have I got enough money sitting there to be able to come out when I need to, right? So many people suddenly get to when their corporation tax is due or whatever tax is due, suddenly realise they've got £10,000, say, to pay to HMRC, and they've got no money in their account. They might have 1,000, and all of a sudden they're stuck trying to scramble together all this money when they don't have it, and it puts them in a really stressful situation. We don't want that. We want a simple process to deal with that. Equally, how do we make sure we keep clarity between what's company and what's personal, right? Getting that all set up. And then when it goes into the personal situation, where does all that money need to go, right? Yes, we've got our day-to-day spending, you know, our budget, you know, you might want to call it. But what about all that other stuff? What about, you know, occasionally you want to go on holiday, right? And you suddenly realize, oh yeah, you know, I deserve it. I want to go on this holiday. It might cost £500 or £1,000. Where's that money going to come from? If you're just following a monthly budget, even if you are following a monthly budget. What about emergencies? Let's say you get ill, okay? And you suddenly need a whole load of money. Maybe you lose your job, right? If you're working through a company, this is so important. You know, there have been periods of times when I got really unwell, maybe 3 years ago. I had to stop working for, at least 6 months, right? Luckily, I had savings there to be able to cover me for that period of time. But a lot of people, if they don't do that, they don't have that emergency fund, then when you get into a situation like that, you get really stuck. So we're going to go through that and how to make sure we deal with that as well. Financial freedom fund, right? Yes, we want to save up for these things that, you know, take a little bit longer to buy or they're a little bit more infrequent, but we want to make sure we're setting ourselves up for a strong financial future as well, whether that's retirement, whether that's going into investments like property or the stock market or some kind of portfolio. We want to be building up our wealth so we become financially stronger, not just spending day to day or for those holidays and so on, right? We want to be thinking longer term as well. And then lastly, our personal tax. So if you're earning money through a company, then you're most likely going to be doing your own tax returns, right? You might have an accountant to do it, but it's your responsibility to pay that money. So, you know, you don't want to suddenly get to the period when you've got to pay your personal tax and not have the money there to pay it. Or, you know, have money saved up for your financial freedom or some nice like holidays or something, and then have to eat into that for your tax, right? You don't want to be in that situation, right? You want to have it all set up in advance, right? So this whole process is around getting in a way where it's automated, it's simple, and there's a system in which you can take that through so that you know each of those key areas are covered, okay? So guys, shortly I'm going to go through some slides, all right? Don't worry, don't switch off. Okay, I've kept it as simple as possible, but guys, it's so important. You know, so many videos out there focus on, you know, the fluffy stuff, empowering you to do the right thing and build out your vision and save more, go out and drive more money from your business, right? But not many people talk about the practicals. What do you actually need to do to make this work? So this video is all about that, practically how you set up your bank accounts and flow the money through those bank accounts to make sure you're covering all the really important areas. Okay? All make sense? Great. So let's start off. So first of all, okay, this is for people who earn their money through a company. You might be a contractor, you might have a business that's set up through a company, and the money, that company makes money. Okay, it's not you that makes money, the company makes money. So you work, or the company provides work to something or somebody, or provides a product, and in exchange makes money, obtains income. Okay, so let's just say, for example, we're in a situation, we've got John, okay, and John's business is called John Limited. Okay, so you've got a company called John Limited, and you've got the person John. All right, so we're going to use this example. John's company makes £4,000 a month, right? Just as an example, all right? Now, the first thing to be clear, right, is the company and the person needs to be kept very separate. So John Limited and John needs to have a clear line between them. Now, a lot of people who earn money through a company don't keep this clear line, and it all gets very messy. So we want to make, first of all, that clear line and distinguish between it. Because from a tax perspective, they're very different things. And if you start merging them together, it gets very messy. It's going to be very hard to submit your taxes, and you might get it wrong. You might get fines, penalties, and get into some real issues. So you don't want that, right? You want to keep it separate, trust me. So then the next thing then is to think, well, before I even think about taking money out of this company, okay, to actually spend, right? So John wants to take money out of his company. He's got his business, he's making money, right? So naturally he wants to take money out of that business. But before he does that, he's got to make sure he's covering off two really important areas, right? One, the company tax, okay? Because every so often, maybe yearly, every 6 months, maybe quarterly, whatever it is, that company's got to pay money to HMRC tax. It could be corporation tax, it could be VAT, it could be other forms of tax, but it's got to pay tax. And guys, this is not a video on tax and stuff. So, you know, if you've got a company, you should absolutely be using an accountant. So you want to be going and speaking to your accountant and saying, how much tax do I typically need to pay? And the simplest way to do this, just to say, accountant, Mr. Accountant, for every pound I make in my business, roughly, how much tax do I need to pay? Okay, so he'll probably ask you some information, how much do you roughly earn that year and so on. And he'll say, I don't know, for example, it might be 25%. So for every pound you earn, you need to pay 25 pence in tax, okay? So the first thing you do is every month, say you're making money into that company, you want to be setting up a separate account for your tax. So you know you've got it when you need to pay it. So you take 25% of, say, the $4,000 you're getting each month, and you put that into that separate account, that £1,000. So John's making £4,000 from John Limited. He puts £1,000 into that company tax account. So when he needs to pay his tax, he's got that. And you always want to increase that a little bit more than you think it might be, just in case the tax is higher than you expect. If it's lower, great, then you can redistribute that and do something else with it, but you know you've got enough there. The other key area is your company costs. So you might have to pay your accountant, right, to do the accounts of the company. It all depends on what kind of company you have and the kind of costs you come through. Now, if you're a contractor, the expenses to that company might be very, very low, right? Or if it's a trading business and you've got loads of input products to cover against the money you're making, then the cost might be really high. But what you need to make sure is that you're covering those company costs in the company. So in my example, I've kept it small, £500 a month. Yeah. So if you're not sure about this, you can just go back over the last 12 months, 6 months, whatever, and just roughly work out how much on average you pay each month in costs around your company. Yeah. So that's the company. So first thing is, make sure you're covered from a company perspective before you move into the personal situation. So we've got our £4,000 income, 500 going to a company costs, £1,000 into income tax. So roughly speaking, left over is £2,500, right? So for this example, I'm just going to assume that the leftover all goes into your personal situation. So moving into your personal bank account. So you're going to have your main bank account, right? That's for you personally. So John has got his personal bank account. That £2,500 goes across. Now it might be a dividend, it might be a salary. It depends on your situation. Your accountant's going to be able to tell you exactly which is better for you. But whatever it is, let's assume you've got £2,500 coming in each month. Now, a few things before I start going into detail here. What you want to do is you want to make sure as much as possible you're keeping it like a system, right? So it's regular. So your income might be up and down, your costs might be up and down, right? But you want ideally the money going into your personal account to be regular, okay? So in this example, it's £2,500 a month, right? Now the income coming in might not be £4,000 a month. One month it might be £2,000, the next month £6,000, the month after £5,000, but on average, let's say it's £4,000 a month, okay? And that's the key point. If we get the averages, then we can be consistent month to month and it's much easier to follow the process. If you'll keep changing it each month, then it gets really complicated because you're going to have to keep every month working out how much you need to move around. If you've got the average, you can just do it automatically, a standing order, £2,500 from company to personal account, really easy. And you can just say, keep paying that amount each month systematically. Yeah? The next one is, you've got all these different things that you want to be spending money on. Now, you don't want to get crazy and set up 20 different accounts, but you ideally want to separate out the main types of ways in which you're going to spend your money or use your money, right? Okay. So before we go into that, let's cover off an important point. And this is something I'll talk about in a lot of videos, but I'm going to go that one level lower here. So your personal income, right? So money coming in, okay, needs to equal money going out. Okay, it can't be higher going out than coming in because that is when you get into debt. So the two main areas in which money goes out is spending and saving. Okay, so spending and saving needs to equal your income. So let's look at that next level. When we look at spending, okay, there's two main areas we want to be thinking about. So there's the one which everybody thinks about, the budget, the day-to-day, going out, buying food, you know, going for a drink, like taking your girlfriend out, buying a small gift for a friend, whatever it is, right? That's your day-to-day spending where you're thinking about it, right? But if you think about it, also you have your automatic spending, rent, bills, right? All that kind of stuff. Maybe your subscriptions, the things that you don't actually control, consciously do. They just go out of your account automatically. They're two separate. We'll come on to that. It's an important point. But you need to clearly identify those two areas. The other one is saving. Okay, so there's 4 main areas you want to be thinking about when you're earning through a company. First one, this is really important, infrequent spend. So guys, think about it. John, right? In our situation, John, he pays rent, right? He's staying somewhere, he's paying rent, automatic. He's got his bills for his house, automatic. He's got his subscription to his Netflix, automatic. He goes out, he buys a couple of drinks on a night out, day-to-day spending, right? Takes his girlfriend out for a meal, day-to-day spending, right? He might buy a new DVD to watch at home, day-to-day spending, okay? It's usual stuff that happens regularly, right? Like within the month. On top of that, okay, this is big. This is where a lot of people get stuck. You've got your infrequent spend. So when you want to go on holiday, say in 6 months' time, you're following your spending day to day, but then all of a sudden you realize you want to go on holiday, you need £1,000 for that. Where does that money come from? Okay, that's when your budgets go crazy and don't work. So the way to do that is you want a separate account for that and actually save towards those bigger items. Okay, it might be holidays, it might be big gifts for friends, it might be saving up for a computer or a car, whatever it is, right? Infrequent. The next one is emergency fund. So think about it. John's making his money through a company, he's a contractor, he's doing well, he's getting paid really well, he's happy, he's got his all budget set up, he's making sure he's spending within his means day to day, he's saving up for his infrequent spends like holidays, but boom, he loses his job. And he can't find a job for 3 months. And by this point, he's really, really struggling because all the money's dried up, right? He's got no money coming in for his day-to-day. He's got a bit of money saved up for his infrequent spend. Where's this money going to come from to cover those 3 months? Then he's scrabbling around, trying to get on universal credit, trying to get money elsewhere, borrowing money from family or friends, and it gets really tough, really stressful. Maybe he can't even do it. Maybe he even goes bankrupt. Who knows? But that is when you get into messy, messy situations. So what you want to do is you want to have that emergency fund. Minimum 3 months you're spending, but ideally more, maybe even 6 months. Depends how risky your job is. If you're working a job when you could be dropped like that and your whole income goes like a contractor, maybe you need more like 6 months. If you've got many different customers that are paying you money, right? So yes, 1 or 2 people you could lose, but it'd be really unlikely for you to lose everyone. Then maybe you need to leave a smaller emergency fund, but you definitely want that emergency fund. Third area, your financial freedom fund. So guys, John's, he's doing all the right things. He's spending he's got his budget each month. He's keeping to that. He's got an amount of money set up for his automatic spendings like rent and everything. He's got money saved up for when he wants to go on holiday. He's got that reserve amount for if he loses his job or gets ill, right? But what happens when he gets to 60? What happens when he gets to 70? Okay. What does he do? He still needs to be earning each month to cover off that day-to-day spending, to cover off those holidays, to cover off if he loses his job temporarily, right? He's got nothing left over to be able to retire, to stop working if he wants to. So the financial freedom fund is all about being able to stop work if you want to. Now, ideally, you want to be in a situation where you're only working, doing stuff you would do even if you didn't have to work. And that is a big thing that I push and a lot of my videos cover off, right? But until we get to that point, we need to be working out how do we build up to it, right? And to be able to do that, we need to build up money to be able to give us that freedom. So part of your money each month needs to be going to that pot to get there. Now that could be a pension, all right? So like very traditional approach where you can't touch it until you're 55. Or you could do it more flexibly where you could be taking that money, saving it and buying properties with it. investing in the stock market, going into portfolio approaches, whatever your approach is, but it's building that money up so that at a later point in time, you're able to stop work and be able to use that money to live off until you die or pass on to friends. Sounds so morbid, but that's effectively what it is, okay? The last area is tax. So yes, we've looked at company tax, but if you're earning money through a company and then getting paid into your personal name, usually you've got to pay personal tax as well because you've got to do your own tax return. So again, you should be getting an accountant to do that. And that person should be telling you how much you need to put to one side for it. But that person tells you that percentage and you need to be keeping that to one side. So when your personal tax is due, you can just pay it, right? You're not, again, scrabbling around trying to raise that money to give to HMRC. And then what happens is if you've not saved it, where do you go? You go to your financial freedom fund. You go to your emergency fund, right? And then what happens if you lose your job a month after you've got to pay HMRC for your tax? You're stuffed. So John, in this situation, is very sensible. He takes a bit of money that he's making each month and he puts it into a separate account for his personal tax. So when it's due, he's there, he can pay it, it's all good. Make sense? So in summary, you've got your income coming in. Spending and saving are the two key areas. For spending, it's your automatic stuff like rent, bills, and then you've got today, which is stuff that you choose, like going out for meals or drinks. For saving, 4 key areas. Infrequent spend, like holidays. Emergency fund, if you lose your job and you need to live off that. 3, your financial freedom fund, so that you can live off that when you don't want to work anymore. And then lastly, tax, so that when your personal tax is due, you can pay that. Okay? So I'm now going into each of those areas. So you effectively want an account for each of them. But firstly, your automatic payments, okay? So like rent, bills, that should all just go out of your main personal account, okay? So whatever it is, you want to work out roughly how much you pay each month. Maybe put a little bit of buffer in there. In this example, John pays £1,000 a month on average to his automatic spendings, okay? Stuff he doesn't control, it just goes out automatically. So you want to make sure there's enough money in the main account each month to be able to do that, okay? Next, the day-to-day spending, okay? So this is what he's choosing to spend. You want to separate that out. Go set up a separate bank account for that and move money automatically, like a standing order, from your main account into that separate account day-to-day. So you know that's all you can spend. So in this example, 500 a month. John's got 500 going into that separate account and he's got a card for it. So you can see how much is in there and he's like, great, I've got 10 days left. I've got £200 left to be able to spend this month. That's all I can spend, all right? It's very, very simple and easy, okay? Next, your infrequent spend, okay? So you want to agree an amount of money each month that you're going to put away for those holidays, for those big presents, maybe a car, computer, whatever it is. So John, in this example, is just putting $250 a month into a separate account. So he's just doing that. It's automatic. It's $250 going there each month so that, I don't know, in 3 months' time, he wants to go on holiday. It's like, great, cool, I want to go on holiday. Someone's inviting him. He's like, great, how much is the holiday? £1,000. Looks at his account, he's like, oh, only got $750. It's 3 months in. Sorry, I can't do that holiday. We have to do it in a month's time. Or, you know what, really want to do a holiday, but let's make it a bit cheaper. Let's make it shorter. Go somewhere a bit cheaper, so it's 500. So I can afford the holiday I've chosen. It's within the budget I've set. Yeah, it allows you that control. Next one, emergency fund, right? So let's say 6 months later, John loses his job, okay? He's like, oh dear, right? No more money's coming in, right? So what does he do? He still needs his money for his automatic spending, still needs money to day-to-day living, okay? Maybe he still wants to go on holiday during that period. He's got that money in that emergency fund. In this example, he's got £10,000 sitting there. You might think, wow, that's so much money. Well, is it? You know, if he's spending on average 1,750 in this example, okay, that's okay. It's over 5 months. So you might think, what, 5 months? But if it's, you know, he's at risk of properly losing his job and losing all income, right? It might take some time. Then maybe that's quite a safe place. So John's relaxed. He loses his job. He can't find a job for 3 months, say. It's all good because he can just use that emergency fund, and each month he takes that money, puts it into his main account for his automatic spending, takes 500 into his day-to-day spending account, can carry on spending, can still go on holidays. His life hasn't changed. But then when he gets that job again, okay, 3 months later, right, now what he needs to do is he now needs to start putting money back into that emergency fund to build it back up to 10,000 so that he's then safe again. So that if he loses his job again, it's all good, that money is still there. Next, financial freedom fund. So John wants to become financially free at some point, right? And so he wants to build up that money so that at some point later on in his life, he can stop working, chill out, and be able to live off that money. So in this example, he's putting £500 a month into that account, okay? Separate account so he knows where it's going. This account needs to be a one-way street. Money goes in, money never goes out until you stop working, and you know you can stop working because you've got enough money in there. The only way that money goes out is to actively invest it. So you might save it up and buy a property. You might put it into an investment account to be able to invest it in, say, a portfolio. You might put it into a pension, okay, and do it that way. Whatever it is, that's the only way you're using that money. You do not go into that account under any circumstances for emergencies, for a holiday, whatever it is, because you've got your other accounts for that, right? And that's the beauty of this setup. Okay, lastly, your personal tax, okay? So again, he's gone to his accountant like for the company and he said, right, on average, for every pound that I'm receiving from my company in my personal name, how much money do I need to pay in tax based on how much I'm planning to take out this year, for example? Okay, great. Accountant says 10%. So it's like, okay, cool. Well, I'm earning £2,500 a month. So every month I'm going to put $250 automatically into this tax account so that when my tax comes due, boom, it's there. All good. Take the money from there. Don't need to worry about it. Don't need to pull it from elsewhere. So now we have it. You're looking at this slide, right? All looking a bit crazy, but fundamentally it's very simple. You've got your company account, your personal account, okay? Company, okay, you've got costs and tax. For your personal main account, you've got 6 areas: automatic spending, day-to-day spending, and 4 ways in which you save. Infrequent spending, like holidays, emergency funds for if in case you lose your job or get ill. 3, financial freedom, so you can stop working at a point in time in the future. And then personal tax, so you can cover off the tax you owe in your own name. Right. Sounds simple, right? Now, guys, this may look a bit complicated. The money's flowing all over the place and there's lots of numbers here, right? But I know, trust me, this is as simple as you can really get it, okay? And once you set it up, it's actually quite simple because most of this should be automatic, okay? So the movements of money should work the same each month, okay? So the money going from your company to main, automatic standing order, and then from all the other areas in your personal situation should just be automatically going in. X amount of money, 500 a month automatically into your day-to-day spending, 250 into infrequent spending, all automatic. So it just happens seamlessly. You're not having to mess about with it unless something changes, right? Now, the last thing I want to talk about, right, is what kinds of accounts you want to be setting up for them, okay? So let's talk company first. So your main company account, you want an established bank, okay? Because if there's an issue or complications or things mess up, you want to be able to call them. You want the reliability, the assurance around that, the checks and measures, okay? So for example, I've used NatWest here, very big business bank account. And also, at the moment at least, the first 18 months in which you use that account, there's no fees to use that account, okay? So a great account to start with because it's free for the first 18 months. And then afterwards, you can pay, but then you can look to maybe go to another account. But really good example. And it's a big, well-established business. The company tax just needs to be a saving account, separate savings account with NatWest. Okay, really simple, and it just automatically goes there. When you need to pay the tax, you just pay it out the savings account. So the NatWest is all you got for your company. Okay, in this example. For your personal situation, guys, it's the green writing on this slide. Okay. So in your personal situation, you're gonna have a main bank account. Okay, and the money's going to go into that account, 2,500 each month in this example. The main bank account needs to be an established bank account like HSBC, Lloyds, NatWest, or whatever. Now, I personally believe First Direct is the best because they're a really established big brand. Okay, they're actually a subsidiary of HSBC, so they've got a huge bank behind them. But their customer service, their reliability is amazing. Okay, when you call them, they answer straight away, answer your questions. It's always someone that understands you, really clear line. I am very impressed with them. I've been with them for years. I will not use another account for personal. But it doesn't matter. You can use anyone as long as it's an established bank account. But if you're not sure, you want to maybe switch, First Direct is great. Okay. Now, for your day-to-day spending, you want it to be totally separate. And you want to have a bank card with it, okay? Because for that day-to-day spending, you want to just be using that account, right? So when you go and you buy some drinks or a meal out, that's the account you're using. That's the card you're using, right? You're not having to mess about with stuff. So I personally think an account like Monzo, a bank account like Monzo is great because it's easy. It's got a cool app. It's very easy to track your spending. It gives you notifications. It's very user-friendly. It kind of, in a way, makes it fun. So day-to-day spending is very easy to follow and see, and you know how much is in there, okay? Really cool app. But there's other ones like Revolut's cool, or you can use First Direct and have a separate account if you want. Just make sure it's separate, and ideally one that's nice and easy to use with a separate account. Then, the next one is infrequent spending. So infrequent spending, again, is something you're going to actually have to spend fairly often. Not each month, but maybe every 3 months, 6 months, or whatever. So when you go to buy that holiday, you don't want to mess about moving money. So ideally, it's a separate account with a debit card. So when you go to book those flights, boom, you can use that debit card. When you book the accommodation for a holiday, boom, you can do that. You can use that debit card, all right? Really easy way of doing it. Very, very simple, because then you're not having to move money again. Now, the other accounts, you don't need to have as complicated facility. You just need a very bog standard savings account. So that could be with First Direct again, and they can just be just separate savings account. The money just keeps getting separated into to keep it separate. So your emergency fund, again, it should just be built up there, and you should very rarely touch it, if ever. Should never need to touch it. So it just builds up in that emergency fund and just stays there separately, and you know what it's for. Okay, separate savings account within First Direct. Financial freedom account, again, just a separate savings account. Money just goes into it and just builds up and accumulates. If you're moving it into something else, like a pension fund or an investment account, something like that, again, that money would just then automatically come from that savings account or directly from your main account if you really wanted to, and it was just regularly moving into it. It depends on what you're doing when it comes to those investments and your financial freedom account. Then lastly, personal tax. Again, just a really simple savings account. Separate, money goes in, it just builds up. And when you need to pay your tax, it just goes out that account. Really, really simple. So, in summary, you've got John. John has John Limited, okay? John Limited makes £4,000 a month, has his money coming in. John makes sure he's got enough money going out from his company to cover tax and costs. Costs just go out automatically. He's got a separate account going in for his tax to make sure he's got enough money there for when he needs to pay that tax. Then he decides how much he's going to move into his personal situation. Separate bank account into his personal name. So John has, for example, First Direct. First Direct is a main account. That's where all his automatic spending comes. Rent, bills, all of that stuff. From that, he moves each month an amount of money each automatically to a separate account like Monzo to be able to do his day-to-day spending with a debit card. He has another account with the debit card for more irregular spending, like holidays or gifts or saving up for big purchases like a car. He's got a separate card for that so that he can do that when he needs to and not have to move money. Then you've got a savings account for the rest of the areas. Emergency fund, savings account built up, ready in case of emergency. Financial freedom fund, building up for his financial freedom in the future. It may even go to an investment account if he's investing through that, or a pension fund, whatever. If not, if he's saving up for something that's bigger, like a property, he just puts it in that savings account. And then lastly, personal tax. Normal, simple savings account, building up for when he needs to pay his personal tax. Guys, I hope that was clear. I hope that was helpful. Really, in essence, okay, when you're making money and you're having to manage that in a complicated way, you want to keep it as simple as possible. You want to know what that flow is regularly. You want to have a clear understanding of how much goes in each area. And by doing this, by mapping it out on one-off situation and then setting up the accounts for it, you know you've got enough money parked away for each of these important areas. Then you can carry on your life knowing you can just chill and enjoy what you have to spend day to day on your budget. You have enough money parked away for holidays and stuff, and all those other areas like emergencies and tax and so on. Okay, guys, I hope you found this useful. I hope you found this as helpful and valuable. I think this is probably one of, if not the most important areas when it comes to managing your money. If you think I've missed anything off, let me know in the comment section below. More than happy to add, clarify, do videos on future topics or build into areas that I haven't gone into detail here. If you've liked it, please do like the video, subscribe to see my weekly videos going forward. If you know people in your life that would benefit from this content or others, give it a share and let them know about this video too. Guys, I will see you next week. Have a great week. Bye-bye.